Developed market government bond yields jumped last week after fresh U.S. tariff threats, though the headlines focused on the sell-off in Japanese government bonds. As the U.S. backed off from new tariffs, DM yields fell, showing how immutable economic laws again came into play. Bond markets have started the year with a bang. Developed market bond yields jumped, particularly in Japan, where 40-year yields saw historic spikes. These moves quickly grabbed headlines, but were short-lived as immutable economic laws limited extreme outcomes yet again. Meanwhile, U.S. corporate bond issuance is forecast to hit a record high this year, as companies are leveraging up to fund the AI build-out, as described in our global outlook. This is a feature of the current market environment, in our view. The headlines around the government bond sell-off focused on JGB yields. But we think the story is a global one, where geopolitics are running up against immutable economic laws, specifically the need for sizable foreign investment to finance U.S. debt. Any spike in long-term bond yields could quickly raise questions about debt sustainability. This has already played out, with the result being a moderation of policies. This risk of higher bond yields comes against the corporate sector that's leveraging up. Public and private balance sheets have diverged sharply since the financial crisis, but U.S. corporates have room to take on more leverage, and they're doing so from a position of strength. Yet more leverage overall makes the financial system more vulnerable to shocks, like the yield spike we saw in Japan last week. Against this backdrop of a surge in issuance, we're more selective in fixed income. We prefer high yield over investment-grade debt and short-term over long-term credit. We also prefer direct lending and private credit and favor established, large borrowers. The recent spike and subsequent decline in yields shows how immutable economic laws can limit extreme outcomes. We stay underweight long-term DM government bonds, but still see select opportunities in fixed income,